Welcome, good afternoon and welcome everybody to the session on setting yourself up as a contractor. Now, what you need to consider, including insurance, tax and documentation. This is a panel session and I'm not Jamie Blackburn, who was originally set to contribute to the session, but he's been unfortunately detained. So I'm standing in to assist. And today, with us today, we have a couple of gentlemen who are here to assist. Any questions you have, please drop those into either the Q&A in the chat, and I'll relay those through to our panelists, and we'll see if we can get some questions answered. So joining us today, we have Deane Moyle, who took a risk of his own back in 2016 and set up Stamford Insurance Brokers. He's a director of Stamford Insurance Brokers and is here to talk to us about managing risk. There's someone who's obviously set up his own business in the last sort of 5 or 6 years. That's great to hear. And Gareth Denniston, who is from everyone's favourite government department, Inland Revenue, working in the community compliance space. So welcome to you both. Perhaps we could just start with, from yourselves, gentlemen, just a quick little bit of background from both of you. Deane, would you like to lead off?
For sure. Hamilton boy, originally based in Auckland now. Started my insurance career in London in the mid-90s, came back home and worked for the major brokers for 20 plus years. Got very sick of that by 2016 and was lucky enough to get some support with an older contact, Duncan, and we established Stamford Insurance Brokers, and it's been going, the first couple of years was hard, but yeah, 5-6 years into it now, it's fantastic. And we have a large book of business in the entertainment sector, construction, development, and some general property and liability business. So quite a spread. But our contact with the entertainment people came from a random phone call about 5 years ago from our internet page. And yeah, we've built up 10, I think 12 clients in the space now, mostly guys and girls who have taken the plunge and gone out contracting. So yeah. Based in Auckland, I think, yeah, so Auckland based. I haven't been to Wellington for a couple of years, but yeah, it's a shame we missed the attending in person this year.
I see, and your clients are based across the whole country?
We are, yep. We try to avoid the South Island, but it's, you know, just for travel, just to make it easy. But it'd be 70% Auckland based, and then the balance spread around the country. So yeah, but most of the entertainment people are out of Wellington, unsurprisingly.
Okay, and welcome to Gareth. Gareth, what do you do?
Well, I work for Inland Revenue. I'm currently in the community compliance space. So this is us. We educate using seminars, expos, career days, anything that we can do just to try and educate businesses and individuals into doing what they need to do in relation to their tax and how to do it as easy as possible. So we're trying to make it as easy for the customer as we can. I've been at Inland Revenue for about 15 years now. I started in the contact centre in Dunedin, all the way down in the bottom of the South Island, where I had various roles with student loans, income tax, family tax credits. I moved into community compliance and then jumped into the business transformation project for 3 years. So I've just come back from there, where I moved to Wellington, and I'm stayed ever since. But I'm back in community compliance, been back for about 3 months. And yeah, pretty much anything to do with tax, I'm your man.
Oh, great. Okay, well, thank you to you both. I'm going to start off with a question of my own. I've pretty much been a salaried employee for most of my working life, outside of some casual sort of fruit picking stuff when I was a much younger lad. I recently, well, not so recently now, but I left salaried employment before my current role, and I spent a year essentially what most of our people in the industry do, which is freelancing, really, going from short-term, show-related contract work from that to another. In that time, I had a little bit of a, really give too much thought about what was necessary to set myself up. Should I be GST registered? Or should I just, pay the straight PAYE, which is the path I elected to go down, essentially. But just very quickly, perhaps for those who are looking at that question, are you able to quickly say what the merits might be between those two?
Yeah, absolutely. I can definitely feel that. So there's a legal requirement if you're earning over $60,000 that you need to be GST registered. So if that's the situation, and that's in any 12-month period, it's not in the income tax year, so it's in any 12-month period. If you've earned 60,000 or likely to earn 60,000 more in the next 12-month period, you're actually legally required to be GST registered. So most people can fit into that category. You can be voluntary registered if you're under the $60,000 mark. It just means that when you're invoicing and you're doing your receipts, you're just going to need to make sure that you have the legal requirements on each of those, which would be that it says tax invoice, that it's inclusive of GST, etc., etc. And then what you can do, you'll be filing more returns, either 2 monthly or 6 monthly, depending on your income or how much you're earning throughout the year. So that's what you'll do if you are GST registered. But if you're earning under 60,000, it's completely up to you. You can voluntarily, you don't need to. There's no legal requirement for you to do so, or as such. With your income tax side of things, if you just decide to just do normal income tax, that's when you'll be needing to keep good records. It's really important, and we can't stress this enough. Record keeping is vital when you're doing contract work or self-employed work. You need to be keeping everything for about 7 years. That's the legal requirement, and that's what we would expect from you. Even when you stop doing work, say you've worked it for 5 years, you still need to keep those records for 7. So we just need you to be really working on that record keeping. It's something that we really do think you should do. And of course, when it comes to record keeping, it's also all the receipts, the invoices, everything that you invoice somebody, or if you buy something or you have an expense to claim, that all needs to be kept as well for the 7 years as well. So it's just vital when you start setting up record keeping. Can't say it anymore. But yeah, so that's the GST requirement for registration. And what I would suggest you do for your income tax, a cash book is good. It will show all your income, all your expenses, helps with your GST, and it helps with your income tax. So if you can get a good cash book, we've got one on our website free of charge. If you guys want to look for it, just look up for record keeping and grab the free cash book. Did that answer your question, Phil?
It does, thank you. The key take home there for me is just something I've always found a bit of a challenge, is that record keeping and that sort of approach. So that's quite helpful. It's good to know that, I think that comment there about the tools being available on your website.
Yeah, absolutely.
The assistance is also there as well. I think that's pretty good. So one question I have already. So in relation to keeping the records, there's a question about a hard copy of that compared to an online platform like Xero. Is that
up to you? Whatever suits you. If you want to keep hard copies, good. If you want to do it digitally, fine. If you want to take photos of it, that's good too. Just any way that you want to keep that records, or that you find is best for you. And as long as we say, can we see them, and you can show them us, perfect. That's all that we need.
Yep, well, that's good to know. Hope that answers the question there we have there. So something else that was up for consideration, and Deane, was when I re-entered that sort of casual freelance world and was working for New Zealand Opera and those sorts of organisations, the question of liability insurance came up.
Yep.
And I actually was able to engage under their public liability insurance, rather than setting that up on my behalf. But if I was to go down that path, what are the sort of common questions that you encounter? What do you need to look at?
It's there really is a single policy that is a must-have. There's others that you really should have, but the must-have, the one you're referring to, is public liability, general liability, broad form liability. Term we'll use is public liability. So it's a policy where is triggered where you damage through your actions somebody else's property, and you're legally liable for that damage. Okay, so if you're in the opera's premises, or you're in there and you damage somebody else's property through a negligent act, their insurance company will settle their loss and then come after the person they think is responsible. If they think that person is you will need a public liability policy to stand in your place and defend you and potentially settle those legal liabilities. It's relative. There's no statutory obligation. There's no legal. And you don't even have to buy motor vehicle third-party liability in New Zealand, let alone public liability. It's completely up to you. But where you will get boxed in is in your contracts. Typically, if you enter into a contract in a freelancing model, they'll ask you for public liability insurance, typically $5 million worth of cover. And if you're starting out, so 1 to 2 full-time employees, less than $200,000 worth of income in a 12-month period, you'd get $5 million of cover for about $1,100 plus GST. So about $1,000, $1,500. If there's hot works or anything that could start fires, let's put it simply, it would be a little bit more expensive. But typically, the work you guys are doing, it's going to be about $1,000 for a $5 million limit, which is plenty of cover. Plenty of cover. There's a couple of there's a couple of fish hooks in it though. You can't rely on the insurer to settle a claim on a commercial basis just to make your client happy. If you feel bad or they say you have to settle this, so you're not going to get any more work, insurers just won't do that. You have to be legally liable. They're very strict about that. And contractual liability is not covered. So if in your contract with your client, you say, we will do these things, and if we don't do them, there'll be liquidated damages, or you'll deduct this amount of money from our fees, that's out. So it just has to be legal liability, but it's commonly available. There's about 5 or 6 insurers, very easy to purchase and relatively inexpensive.
I see. And the policy, those policies are normally, I guess, as with the most common insurance policies, are on a 12-monthly basis?
Correct. Yep. So when you set it up, you'll fill in a proposal form, go through a quotation process, typically go to 2 or 3 insurers just to test the market. And yep, they'll be set up for an annual period, and then they're renewed. You sort of start dealing with the renewal 6 months, 6 weeks, 4 weeks out from renewal. Just a couple of tips when you're setting up the insurance. You won't be surprised to learn that there's no sort of industry code for your freelancing work, not like an electrician, a butcher, or, an accountant. You guys do varied things, driving trucks, delivering things, hiring things, putting up lights, rigging. One point I would really like to make is when you're setting the insurance up, the proposal form will give you a little bit of space to describe what you do, but just on a separate piece of paper, list everything you can think of. Insurers can and do avoid claims where they can, and one of the first things they look for is the thing you are doing when you damaged the other person's property. Is that part of the insured business activities? That's number one. So, if you're grinding some scaffolding, but you just said you were setting up lights, they could argue the point. So you really do need to specify if you're going to, do any hot works or work at heights. So it's really important. More the better in terms of the list of activities. It's key, absolutely key.
Yes, I think, going back to, my experiences earlier on in my career. The businesses I was working for, the insurers we had knew our businesses, and it wasn't solely about public liability. It was also about other terms of insurance that we needed for the business as well. Your typical maybe your vehicle insurance packages as a business compared to a personal sort of ownership thing. But then even things like elements of required freight insurance for project work and things like that. The instruction was always to talk to our insurance broker. He understands the business. Give him the details. He will provide the necessary certification and what have you. So
what you'll find when someone's starting out, they'll typically just take the public liability, but it's really important to do to follow what you're talking about, Phil, is to realize the limitations of the public liability insurance. Look at what you're doing 3 months later after your client relationships develop. They're asking you to do more things. So if you're moving things in a truck, are you hiring the truck? Do you own the truck? Who's insuring the things you're moving around? There's a lot more to it. Don't solely rely on public liability, but it's always a challenge when you're starting up the business, because you could go through have a nice list of 5-6 insurance policies, and you could get to $5,000 premium very, very quickly on policies you may not need immediately. So it's important to have that conversation ongoing through as your business develops.
I see. Okay, and I was fortunate. Well, one way of looking at it, or maybe not, but our dealings with the IRD when I was involved with in a company-based approach was obviously very, very minimal indeed. If I was setting up as a new business and decided to take the plunge and become GST registered, what sort of things would you expect in the first, say, financial year of your operation that you would be doing as a difference to someone who is a salaried employee like yours truly, to then my first year of being a GST registered company? What would I be expected to do?
Yeah, cool. Absolutely, I can guide you through that. So for the first year of business, you will be trading as normal, or doing what you normally would do as you work. You'll be collecting your invoices and your receipts throughout the year, and you'll be filing your GST returns. Now, your GST returns are generally 2 monthly. That's the one that most people fall under or go under. You can go for 6 monthly if you're earning under $500,000 a year, so you could file them 6 monthly. Going for 2 monthly means that you're just doing it more often, you're doing it more regularly, it's becoming more of a habit, you're understanding your business more, you're understanding your profit and loss and the way that it is working, and what expenses you have more regularly. So it's kind of just a good way to keep an eye on what your business is doing it a bit more regularly. So you'll be filing your returns every 2 months. Basically, the return will be due the 28th of the following month. So if it was March ending, it will be due on the 28th of the following month, which will be April. And this one, we actually moved to the 7th of May due to holidays and Easter. So we actually moved that one for you. It'll be due on the 7th of May, but generally it will be due on the 28th of the following month, along with payment of any GST that you owe to the government for goods and services that you've traded. You'll be doing this right through to the end of the tax year, where it ends on the 31st of March, and then we will be sending you what we call an IR3 or an IR4, depending if you're a company or a sole trader. You'll be then filling in that tax return, which will be due on the 7th of July, and then your payment for that tax return will be due the following February. Dates are moved and changed if you have a tax agent. So if you're actually getting an accountant or a tax agent to do your books for you, we give them a bit of an extension of time just due to the amount or the quantity of tax returns that they're filing. So generally, if you have got a tax agent, it'll be moved to the 31st of March due date for the return, and then payment will be due 7th of July that year. So we give them a bit more time. It's the second year of business that can actually hit people with a bit more payments. And that's just due to maybe if you have a residual income tax bill of over $5,000, you'll be put into what we call provisional tax. And that's where you're paying your tax ahead of time in provision for your your following year's tax bill. So it means that in that second year of business, you'll actually have your income tax due and two or three provisional tax payments for the following year. So that year is the hardest that most businesses go through when they hit that provisional tax. But at that time, of course, you're working hard and you're earning a lot of money, but it's still a lot of payments coming up, plus your GST every 2 months as well. You just got to, budgeting and planning is really important when it comes to businesses and when it comes to doing your tax, just knowing when those due dates are falling. And that's why our MyIR services are brilliant. They just send you reminders when your tax return is due or when your payment is due as well. That answer your first year and almost your second year of business? It is really complicated.
No, that does answer it, in particular that second year. I certainly recall, conversations I've listened in on and been part of over the years where there's been a fair amount of comment around that second year and, a bit of swearing and what have you. So yes, that's a timely reminder. Absolutely. I have a question here from Kevin for Deane, and he's said, I'll read it out here. Deane, you said that insurance companies don't know what we do like other trades. And his background is from the UK, so he's mentioned in the UK, there are many insurance companies who understand what we do in our industry and the risks involved. And he's wanting to know, how can the event industry work closer with insurance companies to make it easier for the freelancer to get the right cover? Is there, I guess, extrapolating that a little bit further, is there a wider industry body that goes out and gets that sort of that feedback or anything like that, or how does that process work?
Unfortunately, Kevin, no, that the UK insurance market is significantly more sophisticated and larger and responsive than it is in New Zealand. The real difference over there is the Lloyd's insurance market, where you can have even regional insurance brokers putting together specific packages for specific industries with a panel of insurers in a Lloyd's market. The Lloyd's, I mean, how many syndicates are there at Lloyd's? 50, 60, 70. In New Zealand, there are really 4 or 5 main insurers, most of them owned by the large Australian brands, either by Insurance Australia Group, Royal and Sun Alliance, Favero. There's a couple of new players, but it's a very small insurance market here, and they are, what's the word? Look, you can put a scheme together. If you put a scheme together, then the answer is yes. But for a scheme in New Zealand, you really do need volume to get an insurer interested. Outside of that, it can be a little bit computer says, right? But that's not to say you can't get the point across. You just have to work with your broker. You have to do a little bit of that legwork yourself and just specifying what you do. And you just need to make sure a human understands what you do and they set the terms appropriately or amend a particular type of policy to suit your needs. So there is a little bit more individual work needed in New Zealand. And unfortunately, it's going to stay that way. Scheme business is different, but as I said, you need significant volume to really make success of a scheme in New Zealand.
Thank you for that answer there, Deane. A supplementary question, I guess, from yours truly. What would, to make a scheme viable, what sort of numbers would you say you would need to look at from an insurer side?
A couple of $100,000 worth of premium.
Right. Okay.
Yep.
Mm-hmm.
Yep. And a fairly benign risk profile, which yours would have. But over time, ETNZ will be able to achieve that. If you can bring people together, you'll find a lot of scheme business in New Zealand is driven by the fear over losing capacity. So people like architects, building surveyors, people who must have professional indemnity insurance in order to trade. So they make sure they band together so they can access insurance either locally or in the US, European, UK insurance markets, because if they don't have PI, they can't work. End of story. So that you'll find that. But hey, the easy answer is a couple of $100,000 premium. You will have an insurer's interest. They will put together wider wordings, online systems, that sort of thing.
Oh, there you go, Kevin. I hope that's given you a little bit of food for thought there. Thank you. Okay, all right. So please feel free to follow through any questions that you have. We're here to provide any information for that. It's another question I would have for Gareth is, if you're a one-man freelancer, which is, or one-person freelancer, and you're managing everything or in that particular way, if you're transitioning to paying other people, say you end up trying to grow a little bit more of a business, so you're then responsible to pay other people and collect the invoice on their behalf. Obviously, as an employer, that's a significant change in your taxable responsibilities.
Yeah, especially for your tax as well.
Yeah.
It does mean that there's a little bit more work on behalf of you for the income tax department, especially when it comes to tax deductions for the wages. Generally, I guess in this case they'd be contracted, so they'd be mostly on the WT tax code with individual rates depending on this type of work. But in that case, you're still taking a tax off and you're still giving it to the tax department for the PAYE portion or the PAY portion of it, because we don't go to, with the WT, not taking any ACC off as well. So the ACC will bill it separately, or bill your employee separately. So what you'll be doing now is every time you pay your staff, so if it's weekly, fortnightly or monthly, you'll be filling what we call employer informations through MyIR, which is the easiest way of doing it. We require those, it's called payday filing. We require those paydays so that we can make sure that the entitlements for the employees are correct that are coming from Inland Revenue. We know we have up-to-date information for the income that the customer's earning or the client or the employee's earning. So we know that they're giving the right FAM out, that they're paying the right student loan, those sorts of things, so that we can make sure that people aren't getting bills where they shouldn't be getting them. So even though you filed those weekly, fortnightly or monthly, depending on the pay frequency that you're paying your staff, your payment for Inland Revenue isn't due to the 28th the following month again. So it's very similar to GST. It's instead of, but apart from the returns, but the payment is similar to GST. It's 28th the following month, returns as you pay. And then you'll be doing that through the online service or through a payroll system such as MYOB or Xero or any of the other ones that can communicate with Inland Revenue and just send us that information directly. Some of them even let you make a payment straight away afterwards, depending on the software that you have. We don't have any recommendations. They've all been working with us to make sure that the changes that we've been inputting into our system is working well for you guys and just goes straight through to us. So if you want to get a piece of software, it's really good. It will just send us all the information and just keep everything up to date, especially when you're employing people, because you're doing them more regularly. You're doing them twice a month or 4 times a month, depending on the frequency that you pay. So yeah, it will increase your time and effort for the work that you do for us. That's probably when you hopefully employ someone to do it all for you, or get an accountant. But yeah, that's what's going to happen if you start employing.
Yes, I think if I'd grown to that size, I would. Yeah, that's obviously where you'd be bringing people on board to help assist with those financial services. Absolutely.
Can I just make a point on that, Phil? One thing we've noticed with our clients in multiple industries who have gone freelance and gone contracting is as they are on that growth path, rather than employing employees, there's a lot of contracting or collaboration between other contractors or freelancers. So just the point I would make about the insurance, never assume that the insurer sees the relationship between the parties the way you do. You know, whether you say, oh, they're a contractor or they're an employee, never assume that the insurer is going to see it that way. If there's a non-employee contracting relationship going on, speak to the broker, check your policy. Once you've done it once or twice, you'll understand whether it needs to be noted, or maybe there's an endorsement, maybe the definition already meets that situation in the wording, but check.
Okay, that's great advice. So much in the same way, if you have a vehicle with your nominated drivers and things like that, if I'm using a simple analogy.
Yeah. Yep.
I see. Okay, and Deane, outside of the the obvious liability, public liability insurance, what other what would be a common insurance service you would see?
There's two other policies that somebody going out freelancing will take from the outset. The most important is a statutory liability policy. The easiest example to give is if you breach the Health and Safety at Work Act and WorkSafe prosecute you, you need the statutory liability policy. If the government, WorkSafe, are prosecuting you, you are going to lose. End of story. You're not going to win, and you need that statutory liability policy to provide legal defense costs and cover reparations. Unfortunately, and this can be very serious, by law, the statutory liability policy can't cover fines under a health and safety prosecution. The analogy would be a motor policy having an extension for DIC fines. You know, the government want to punish you, so they don't want insurers covering the fine. So the policy for Health and Safety at Work Act prosecutions will only cover the legal costs and the reparations, not the fine. If it's a very, very serious matter, the fines are, after Pike River, the fines are huge these days. So it's very important that you understand that the fines aren't insured, and that if you are prosecuted, you need to work in very closely with WorkSafe, because if you dig your heels in or not cooperate, things can get heavy very, very quickly. The final point on that is for, 1 to 2 full-time employees, a couple of $100,000 turnover, you're going to be paying sort of $300-400 for a statutory liability policy. Buy it every single time. It's, in my mind, it's more important than and from my experience, it's more important than the public liability. You need public liability, but the stat liability is critical. The only other one that can be very important, many people don't take it, but it's a property policy covering tools and equipment anywhere in New Zealand. So, rigging tools, audiovisual equipment, that sort of thing. It doesn't take long to have a couple of bags in a van, which is sort of worth $10,000 to $15,000, right? And unfortunately, they can be aggregated, in a van, at a site, in a location, and they do get stolen. Doesn't matter if one thing is stolen, it's almost a consumable, but if it all goes at the same time, that's a significant hit to the business. Unfortunately, the insurance for that is very expensive, because those policies get hit all the time, because there are the theft of contractors' tools, that sort of portable property. I mean, it's just so common. So you're paying about 4.5% on the value. So if you're insuring 15 grand's worth of plant and contents, tools, you'll be paying about $650 plus fire service levy plus GST. So you're sort of you're getting close to $1,000 for $15,000 worth of cover. Plus the excess is going to be $1,000 if they have to break the van's window, or $2.5 grand if they just walked up and walked away with it. So a lot of people make the choice to self-insure, but just be mindful of, if you lose 15 grand's worth of gear, it is serious. And you have to be very mindful if you're hiring things for yourself or on behalf of others. That can be an absolute nightmare, or something you've hired that is extremely high value is taken. The hire companies, if you haven't dealt with it properly, either through your own insurance or their insurance, it can be very painful. But unfortunately, it's not a cheap policy.
No, I do recall yeah, I see when I've been managing rental departments and in previous roles, that all insurance is the responsibility of the hirer.
That's right. Yeah. There's just one other policy you may from time to time, depending on certain types of clients will ask you for professional indemnity insurance. Professional indemnity insurance is where you are a duty of care to a third party. There's an act, error, or omission that you make that causes them a financial loss. So like an architect getting plans wrong, or a structural engineer getting the steel calculations wrong. In industries which aren't professions, it's very hard to frame what the professional indemnity insurance is actually needed. But for larger organisations, particularly Australian organisations, they'll have a contract which says you need 10 million public liability and 5 million professional indemnity. Doesn't matter what you say, they're not going to take it out of the contract. So if you want that work, essentially you have to pay premium to get an insurance certificate to tick the box, right? It's expensive. So if you can't talk your way out of it, talk to a broker very early on so you can get an indication and build that into your fees, because you're talking sort of $3,000 per $1 million worth of cover, completely different cost profile to public liability. Arguably, you wouldn't need the professional indemnity insurance from my understanding of what many of you do, but if the contract says you need it, you can't talk your way out of it. You need to budget for serious premium spend to buy it.
Yeah, that's certainly been my experience with whatever insurance has been contractually required.
Yeah.
That's always been, the cost of that has been covered in the total fee, and as part of that process, absolutely. Yeah.
Yep.
That's
So
great advice.
if you ever get caught and you're on the hoof, you need to make a decision. Budget for $3,000 plus GST per $1 million worth of cover. Don't hold me to it, but just for if you can build that into your fee and your negotiations, you'll be halfway there.
Right, absolutely. Another question, Gareth, a little bit slightly off topic. Obviously, all taxes and everything are paid in our home currency. If you're being paid in another currency, like as can happen from time to time, and as in US dollars, fundamentally we're all tax residents here in New Zealand. Unless we're, that's pretty much how that works. We've had some questions in the past from temporary productions coming in, the cruise ship industry, for example, who put forward a discussion that we may not, you're not a tax resident, we'll pay you in a different currency. But yeah, and that's exactly right. We are all tax residents here. It's payable in New Zealand dollars. Essentially, the income is just recorded as whatever at the rate of exchange is. There's no taxation reporting around loss or gain in exchange at all. That's something you just have under your normal P&L, I would assume.
So basically, when it comes to overseas income, we get this a lot for, believe it or not, overseas pensions as well. So this is a really big thing for a lot of New Zealanders throughout New Zealand. It's not just this industry, it affects quite a lot of few people. Basically, what happens is you'll be recording what month you get that income. On our website, there is a standard or medium rate of exchange for all countries. So we publish that at the end of the tax year. So it gives you the median range of what the tax rate was for that month. You take your income, you get the tax rate and you convert it, or the cash rate, and you convert it into New Zealand dollars. And then at the end of the year, you declare that as overseas income in your income tax return, and any expenses associated to that, of course, will reduce your income for that. And then you also declare any tax. So if they did take any tax off, or you did pay any tax in another country, you do the same thing. You take that tax for you've had for the month, do the cash rate exchange into New Zealand dollars, and then put it into the return as well. So, and then what we do is we judge. We don't say, we judge into New Zealand standards as if you've paid enough tax on that overseas income. If you haven't, then of course we're going to ask for a top up to make it to New Zealand standards. As you said, we're all New Zealand tax residents here. If it was too much, if you've overpaid it, unfortunately, we're not going to refund that back to you. It's not tax that came to New Zealand. It went to, say, the US, for example. So we can't refund that back to you, but we wouldn't charge you anything more because you've paid enough in the views of what we would have charged on that particular income. So that's how you would deal with that. If you're working for 6 or 7 months, you just do the same thing at the end. You just do all 6, add them together and put them in at the end of the tax year. So, and we've got the rates, like I said, on our website. So you just look up for exchange rate and it will come up as one on the search. It's pretty easy.
All right, well, we have another question here, which I'll read out. What do I do if my employer doesn't want to have me bill for per diems? Over to you, Gareth. As a contractor, should be somewhere in my records for IRD on an invoice, and how do I reconcile the taxes on these?
Okay, so per diems are quite interesting. So there was a judgment in 2018, there was a change to the legislation where $80 worth of per diems per day didn't need to have any scheduler tax deducted on it. So if it was $80 or less, you don't actually need to have any tax deducted on it. So therefore they wouldn't take any tax off and they'll just give you the $80 to cover whatever it was to cover food or whatever it was for that day. If the production company did provide food or whatever it was for it to have covered, then that whole $80 is still liable for scheduler payment or scheduler tax off that. So there's some rules around it, but it's basically an $80 kind of leeway. Anything over the $80 would then need to be scheduler taxed or taken through the employer. If they don't take it off, if they just give you the $95, you can just declare it at the end of the tax year to be able to do the tax. GST is an interesting one on it. It's actually paid exclusive from GST. So there's no GST component to the per diems as well. So doing your GST return is quite an interesting concept because you need to calculate the GST on it to include it into the return, if that makes sense. So I don't know, did that, what was the complete question? Because I think I might have hopefully answered everything.
What do I do if my employer doesn't want to have to bill me for per diems?
So if they don't want to bill you for the per diems, you can invoice.
Sorry. I'll read that out again, sorry. What do I do if my employer doesn't want to have me bill for per diems?
So I mean, it depends if they've contracted you with a with the IR330C. If they've done the IR330C, you don't actually need to invoice them because you're contracted through that, and which should come through inland revenue. If it's not through an IR330C, you will need to invoice them. You don't necessarily have to give them. You can hold on to them saying I've invoiced them, and they can just give you the DMs for you. So that would work. That's a way of getting around. If they don't want to invoice, to get the invoices or for you to bill them for it, they just will give them to you. Just fill them out and just hold on to them so that if we ever ask for them, they're there.
Excellent. That's great. Well, I hope that answers your question there, Genevieve. There's some clarity there. Excellent. All right. Any other questions from the panelists? Oh, here we go. One more question, and then I think we can wrap up. Let me see. Okay, and this is a supplementary to that one. So if there is no GST included in them, and there has been an IR 330C, the employer doesn't want them on the invoice, how do you log that in GST return?
Okay, so because there's because they don't have GST, they're exclusive to GST. They don't have to take GST off or charge GST on it. So what you need to do is work out the GST component of that amount that they gave you. So let's say they gave you $80. You work out the GST component. So to do that, you do actually times it by divide it by 23, then times it by 3 will give you the GST component, which will be 15% of the original. And then you can declare that in your GST return as income for that amount. Because obviously they didn't pay the GST, there's no GST exclusive. You can't give that GST, that you can't add GST on and then pay that to us because you haven't gained it in your hand. So you'd work out it backwards.
That makes sense. That's great. And thank you for that. Okay, well, yep, and we've got a thank you there. So that's answered the question. Great. Okay, well, it's time for us to wrap up. Thank you both for contributing to this session. There's been, yeah, I've got some thumbs up there and everything, which is really great. Thanks for extending our knowledge of, you know, what we'd need to consider to set ourselves up as a private contractor. So we'll finish this session with a thanks to our partners, Multimedia, who have been helping us deliver this online, and all of our exhibitors who we've mentioned a number of times today, including those ones who are on the screen saver. So thanks very much, and thank you, gentlemen.
Thank you.
And
thank you.
Thanks, Phil. Cheers.
Cheers. Bye.